Welcome everybody to my next video about options. I think last video was about creating a portfolio and maximizing the Sharpe ratio for everything in compared to stocks, ETFs, or whatever that Microsoft puts in. So this time I'm looking at options. So I've created this option sheet that will look at it'll look at whether you want to buy options, and once you bought it, when to sell, and covered call strategies, protective put strategies, and that's all I've gotten to so far. So I've gotten to four different aspects of options. And so what an option is, you're buying a contract for the right to buy or sell a security at a certain price in the future. But you can exercise that contract whenever you want if you buy it. So usually you don't exercise contracts unless it's under the strike price, which is the price that you agree on to uh, buy or sell at. So if the stock's at 300, but your strike price is at 310 to buy, you're not going to exercise it because you can buy it at a lower price. You can buy it at 300. So why would you exercise that? So you want to, if you're writing these contracts, you ideally want them to expire and no one exercises it, right? Because once that people exercise, usually you're losing money because people are they're looking at the market and they see this it's not an arbitrage, but it's basically they can buy and sell at a lower rate because of this contract, right? So that's what options are in a nutshell. It's very they're the way to calculate the price of the premium. So when you buy a contract, there's a premium. It's not. It doesn't have any value because the contract itself has no value because it's a derivative. So when you buy the contract, there's a premium you have to buy to. You're basically giving the owner of that contract money to uh, for for them because they're giving up their right to like sell it to you, right? Because yeah, it's complicated, but so let me show you the formulas to calculate the price of a contract. These are the Black-Scholes formulas. Uh, so these are just for the Greeks. These aren't really for the calculations. The Greeks are another thing to talk about. So that's another thing. But these are the main formulas to calculate uh, the price. Now I'm not really like a math major or anything, but this when I was calculating this, it was like I didn't want to mess up because there's so many variables. I was like, shoot, there's EQT, EQ, RQT, uh, XERT. It's basically just expanding on the inputs. Now we're getting to the inputs. Okay, so the inputs are what drive the price of the option. And there's basically, I would say there's three main ones, and then there's a few outliers that matter but don't really matter. So the underlying price matters. If the price goes up comparatively to the strike price or down, it's going to influence the price of the option significantly, especially if it's close to the strike price. And if it's above the strike price and it's for buying, so it's a call, then that means it is in the money. So that's what that's called. I don't know why I have this pen. Okay, so we got strike price. That one you can't change. You can buy whichever strike price you want, but if you're writing the option, you control the strike price. No one controls the underlying price unless you control the market, which no one is. Volatility. This is interesting too. So the volatility isn't the historical volatility. This is the implied volatility. This is if you set all the other variables constant. You set the call price, the put price. You just backwards solved for the equation to volatility. That's your implied volatility. It's the markets. So it is relatively it's very markety. It's not really. It's what the market thinks volatility is at the time. And if you look on chains for options, you'll see. I would show you, but my account number's on the screen when I show it, so I just don't want to give away my account number. But uh, you'll see like the implied volatility is at different at different rates for every single call put at different prices. It's not uniform for the uh, the security. So if you just look at Microsoft or look at Plug or something, it's going to be different volatilities for every single option that's trading under that name. So it's not uniform. That's not how you'd expect it. Risk-free rate, I mean, I don't really pay attention to this one too much. I just use 1%. Dividend yield, I mean, if they have a dividend, I would just put it in there. And you can't really change. The dividend yield probably won't change by the time you buy it to when you sell it, unless they declare something, then and that could influence the price. Time to expiration, this is basically the time you buy it, or the time it has until it's going to expire, like the name says. So if you buy it at 15 days, and that's another thing. These are the trading days can either be 252 or 365. For purposes of my broker, it's 365, so I've been using 365. But you can use 252 as well. And that it brings up using 365 is another thing, because what happens on weekends when it's not trading? That means you're losing value while the weekend's going by, because every single day the options are going towards the price that it was on on Friday, basically. And you're basically going against time, and it's not good. All right, so, but it's good if you wrote the contract, because time's on your side, because if you wrote the contract. Anyway, the call price for this option using these inputs is $12.78. Now that's not the market. This is just the Black-Scholes formula. So you want to compare it to the market, and usually it's off by $1 or $2, but it's pretty accurate. All right, and now these are just Greeks, call, put, special. That's part of the formula. Gamma, theta, vega. I'm not going to get into it because it's going to take too long, but usually honestly I haven't really delved into Greeks too much, but call. Some people say that if it's above 50 for the call, then that means that there's a higher probability it's gonna end up in the money, basically. Same with the put, except if it's above 0.5, because these are inversely kind of related, the puts and the calls of the same option. So there's that. So this is the model I created. All right. So we got everything in yellow is the inputs. So I'm gonna have to input some data real quick, and then update it. So let me put up some data real quick. This is straight from my broker. What stock should I use? Let me just use Domino's. Let's use Domino's. Domino's Pizza. All right. I'm going to go 14 days out. I'm going to look at the implied volatility. All right, so right now for me, Domino's is trading at 386. I can't type for some reason. All right. Underlying stock is DPZ. That should formulate some things. Strike price. Should we go in the money or out of the money? It depends what you're looking at in call or put. So let's do 380. Let's put it. All right. Implied volatility for 380 is 24.722. Risk-free rate. It's slow because this table. Let me turn this table off, by the way. when you use what if tables in Excel, it takes forever for them to load, and they load with every single input. One, does it have a dividend? I have to look this up. One sec. They have. We're looking at annual dividends when doing this. We're looking at annual. It's not giving me annual. Annual dividend yield 0.82. I'm just gonna use that number. All right, not 82. Come on now. Okay, I'm just gonna do 0.0082. There we go. Days expiration for this one is 20, not 20, 14. Call 26, 20, 28, 11.4 and 7. All right, there we go. So the formula predicted 10.89. The reality is it's at 11.4. The put says it should be at 4.72, but the market says 7. So they're not, the put's a little off, but so for the model I have to update it because it has the copy and paste formulas all over the page. So I just put it in a macro and just hit a button. So it's just doing that right now. So now it's all updated. All right, so now we can look at a few things, right? So we got the stock price the past month. So the stock price, I tried to make it as informative as possible, but basically you can see that it's going up, then basically back down, and slightly up lately. But this is a moving average, and this is a trend line. They're just trying to see where it might move in the next 15 days, 14 days. So I have a whole nother Excel thing going over all this stuff, like trends and all that stuff. So I have another Excel, whole another workbook dedicated to that. So usually I plug it into that instead of here. But that's a good overarching kind of just looking where it's at. And then this is a graph that I like to look at. I have to explain it because these lines probably don't make any sense to anyone, right? So this is where historically the past 5 days, this is where the stock, these are just historical stock figures. This is today. This is right now, it's at 386.15. This is what I put in and it puts it right there. Okay, so now we got to look, it depends on what we're looking at. If we're looking at the call, it's in pink. If we're looking at the put, where it's in, what is that color? What is that color? I don't know. It's so basically this limit, the upper and lower limits are where if you were to hold it and exercise it, then you would make a profit. So for you to make a profit on a call, that means you get to buy it at maturity or whenever you want, basically, because you can exercise it whenever. But you won't exercise it if it's below, because that's stupid. So you'd go above it. So if it's at 392, then you would be able to, no matter what happens to the price, which honestly the price won't go down that much because it's really in the money at that point. But if it goes, you can exercise it at maturity or whenever you want. But you got to understand that the price of the option can go up or down too. So you got to look at the price of the option and see which one you're going to make more money off of. If you're going to hold it to maturity, you might make more money if you just sold the option instead of exercising it at a different date instead of just exercising it. So there's that aspect as well. So we have to let's look at 10 days. This will move it out, but we got to solve. Right? So in 10 days, this is another variable here called implied volatility, which the implied volatility will change day to day. Usually, as it comes close to maturity, the implied volatility will go down. So usually what I would do is look at what the options right now that have an expiration date in 10 days are trading at, and what their implied volatility is. So if we can just take that from that. So I usually just, for the sake of this purpose, I'm just going to put 22. Usually, if you are a buyer of an option, you want the implied volatility to be higher, because the higher it is, the more money, the more chance, like the more the target goes down for you. Like instead of buying it, so let's start with this. Let's just look at this dot. This dot is where the break-even point is, where you make profit. If it goes above this point at 10 days, you make profit. Okay, so it's at 388.56. But if we make the implied volatility 30, let's solve again. Now it's right here. It's 385.87. So you don't even have to, you don't even need the price of the stock to go up. You just need to hold the security at this point if the volatility goes up. But the likeliness of that happening is kind of low, because unless something happens in the market that we don't know, or to Domino's Pizza, then we don't really know. So usually I would just, it's a safe bet that it's going to go, maybe not in a linear fashion, but go to a lower number. So you can look on the chains. So if I look on the chains right now, something expiring today for Domino's has an implied volatility. It varies. It very for this exact option with a strike price of $380, it has a implied volatility of 23. So I'm just gonna put it up to 23. The reason the implied volatility changes is because as it gets close to the expiration date, there's less chance of it to move higher or lower within the time frame, right? So you're going to expect less in volatility because less time will be going by. That's the opposite for longer terms. So that means more volatility, right? So now we get to look at, let's just put it back. What was I going on about? I don't even know. So we're at 388.727. So it's the only reason I have this line here is for a reference point. The real line of the price of the option and the profit of this option is not linear. It is probably, it looks like this. It goes from here and it goes in a curved loop line thing. It's not a line, it's a curved line. So it goes doing a curved line. So if you wanted to buy the put and you wanted so the price has to go down to this 382.27. It's at 386 in 10 days. So that's just a reference point for you. So it calculates the call and the put, and the strike's down here. Notice the strike is in gray. The strike, honestly, when you're buying it, does not matter. What matters is what you bought it at. That's what matters, because that's an expense. So you have to profit from that expense somehow, and that's how this is the expense. This dot plus minus this line is the expense. That's the expense of buying this option. And when you're buying the put, you have to go all the way down here for it to be profitable. If you exercised it, but of course it'll be profitable here in 10 days. So that's why it's kind of misleading, because the exercise point is not that big of a deal. It's more about just selling it at a higher or lower, depending. Probably selling at a higher price when you buy it. So this is normal distribution curve. This just shows you in the last, I think it was like 20 days, this is the normal distribution. So it's a little bit, the mean is negative 0.02. It's basically 0. And So you can predict that the next tomorrow's return is going to be between 4% and -4%. But it's more probable that it's going to be between 2 and -2. Now this doesn't tell you much. Like honestly, this will only tell you a lot if the mean is different. If the mean is 1%, then you have a better skewed. It's not skewed by, you know, distribution terms. It moves to the right, and that's better. So if you have a call, obviously, but it's better to the left if you have a put. And this is just the ranges, and this is really cool. The batting average is the amount of times it goes above 0 in the last 20 days. So it's a higher batting average because it's above 50. That means it's better for the call, but obviously we don't know the future. So this is a historical volatility versus implied. Usually these two are compared, but it's okay. It's basically the same right now. And this is another table to visualize this graph. It uses a what if formula. So I just turned it off. Lol. All right, turn it on. Call. So hold up, my music's so loud. So okay, so basically this is the chart. This is time expiration. This is the price of the underlying, and you can change the volatility too if you wanted to. So that's the third axis. So if you wanted to, let's say, see this is the break even point, basically where it's your profit is 0, but you're not losing. So in 13 days, it's at 387.15, you'd be making a profit of $39. So and you can zoom in if you wanted to. It takes a while for this thing to load because the tables in Excel take a long time to load. So more accurately, it'd be 386.55. You'd be making about breaking even, and that goes up to. And you can move this over, see what you're making every single day for every single price. So it's a pretty interesting tool. It's just slow as heck. All right, 738.55. Basically, you can just chart it out, and you can turn on for put too. Let me just update it. I just don't want to move all the arrows back and forth, but you can do the same for the put. And I'll show you how the put looks a little different because it has the green on the bottom instead of the red on the top. So that's the difference there. So come on, bruh. All right, so the put, turn on put. It looks like that. So you can dissect that. All right, so I'm going to go to the option sell. That's it for this one. And obviously we have the Greeks, and there's a whole nother thing about that. So these last few I've done in the recent days. They're not done yet, but I just thought I'd show you guys. So this is basically what you bought it at and what it is now, and see if you should sell or not. So basically this looks like the graph in the first page. This is basically this part is the graph here, but at this point is where we bought it, right? This is where we bought it. And now this is where it's at right now. And see, the market took a dip, and now it's really into the put. So if you bought the put, you profited $2,294 if you bought this and you held it to this point, which is really good. It's really good. But if every single point along the way, you're not making money, except here and here. But if you bought the call, you're not making money at all, because that'd be a bad move. But I've been looking at this since the last 17 days, so I've charted it every single way, and it's it was really surprising when it went really down. I was like, wow, that's really cool. So, and then you can solve the break even for this. Yeah, so that's basically it for this. This is just more stuff I have. So that's when you sell it. Covered calls. So covered calls are when you write. So you own 100 you own 100 shares of, let's say, whatever company, and you just want to write a call for the 100 shares that you own. So you're going to give someone the right to buy your 100 shares at a certain price in the future. Usually it's above the price that it's at right now, and it's above. It's basically, so if for this one, the underlying was 500. The strike price, you can set the strike price for when you write an option. So I set it at 510, and the IV, all this stuff you have to set. I mean, you don't set this stuff; you just have to plug it in. So then it sets these lines, and let me see. Let's just put this. I think we can change this dot. So this dot would just change. So this will show you the profit at if it expired right here. Then you'd be making this much money, right? But you also make this much money in a different like way of seeing it, because when you're holding an option, you're also holding the stocks. You're also making profit off the stocks too. So profit plus carrying is the legit maximum that you made, because if you don't want to include that, it's 1,567. Right. So if we go up to 550, which is way up there, we're losing, because someone has the right to buy 100 shares at what was the strike price? 510. So we just lost this much profit right here. So that's not good. That's not good at all. So when you're doing a covered call, you want it to be the best profit you can make is right here. Let me do days expiration. I can do one, but it'll be at 0, and it's right at the strike price. That's the best for the call, because you're getting the most out of your stocks, and you're not going above the strike price. So no one's gonna exercise that. And when someone trades the option on an exchange, that's not something to be worried about, because they're not exercising it. So it doesn't matter. It doesn't matter who's exercising it. All matters is if they're exercising it or not. So then strike. And then so this line is a strike. So if it goes past, someone's gonna exercise it eventually. If it goes past this, I call this a premium lost. That means the premium that you gained from someone buying your option is lost here, but you didn't lose out on. You're not negative basically, but you definitely lost some opportunity right there. But when you go above this line, you're basically at a loss. So if you write an option for this site, it's $10 above the strike price for a $500 stock, and it has to go all the way up to 535 for you to lose all of it. So actually, you're not losing all of it. You're just losing the amount. You're negative, but you're not negative like all your stock, right? You're losing, but you're only losing this $100 stock. You're not losing a lot. So so we're at the lower limit. So let me show you. 490. We're still at a gain. 555. 480. Basically, if you're no one's gonna exercise it because it's way below the strike price, but you also own the stock, so you don't want it to go down. So here you're losing money because the premium. This is if it goes below the premium that you gained, then you start losing money. So that's covered calls for you right there in a nutshell. So if you make a graph like this, it's very easy to understand, and you can manipulate it in different ways. All right, let's go. And oh, by the way, this line is if you want to cover your position by buying back your option. This is when it's at the call price. So it's, if the stock goes up to here, then the call price is going to be 15.67, which is what we have. If it goes at any point along this line, along 40 to 0, it's going to be at the same price. So you can buy it back for the same amount. Anything under this line, you can buy it back at a lower price. But anything above this line, you're losing money by buying back your contract, which is what you would think, because when you're below this line, your contract is it's less. It's not worthless because it's above the strike, but you still have to account for the premium, so it's below. But if it's above, then obviously it's worth more than it's worth more because it's closer to the end of its cycle, and it's above the strike, so it's more valuable. Yeah, so that's fun. Okay, this is protective puts. So this is Microsoft. So underlying. So basically, a protective put is when you're again holding. These are all like pretty conservative strategies for when you're doing options. Like the more complicated and more risky ones are like the straddle, the saddle. I think it's called something like that. And then the butterfly. I think it's something, the Iron Curtain or something. They have some funny names, but I'm more of a conservative trader. So I was more interested in like the more conservative ones. So the protective put is when you're buying, you own 100 shares of whatever stock. This case it's Microsoft, but you want to hedge against the possibility of it going down. So you want it to go up, but if it goes down, you're insured. That's basically what it is. So, but when you buy an option, you also have to account. This is that line. This is the line I'm talking about. This is the line where you finally get gains from the up if it goes up, because you had to pay for that premium for it to get insured. So there's that. This is where it is now. This is a price, put price, and this is it plus that. And then this is in the future. You can change the future. By going 210. So if it goes below, you're still at a loss because this is the strike price, by the way. And then you're still at a loss because it's below the strike, but it's not below enough for the premium to come back. So you have to go below this line, which is 203. So let's do a 202. Then you're starting to make profits, right? And actually, you don't have to go all the way up to this point for you to make a profit, because you can always sell the contract that you own for a different price. So at that price, let's see, you do 220. So you're making a profit, right? Because this contract put price you can sell, and then you're just making profit off that. So it's all different ways to do it, but basically, you're right to exercise the option may not be the best bet, because you might just want to sell the option. That's what I've learned through making all these, because you'd rather sell now than wait in the future. So that's basically it. That is my options worksheet for buying, selling, covering your call, and protecting your put. So thank you for watching, and I will see you guys next time. Peace.